Bank of England keeps rates at 15-year highs following the US Fed's lead. Britain's Reserve Bank has held the official cash rate at 5.25% despite fears for the economy. Across the Atlantic, the Fed has signalled interest rate cuts next year. So what does all this mean for Australia's interest rate outlook? Are we on the same path as the US and UK? Joining me live to discuss, Shane Oliver from AMP Capital. Hey there, Shane. Thanks for coming on the show. What's your take on this?
Well, I think it's all heading in the right direction. I think one of the big themes through 2023 has been disinflation. We had inflation peak in 2022 at rates somewhere between 8% in Australia and 11% in Europe and the UK. And we've now seen quite a sharp fall. European inflation 2.5%, and obviously US at 3.1%. So consequently, the Fed in this is leading the way. They saw their inflation rate peak earlier than the other countries. They've seen a longer period of declines. So it's understandable that they're now pivoting towards rate cuts. It's still a way off, but that's the direction they're going. The ECB and the Bank of England are also going in that direction too, but they're just a little bit more sceptical that they're lagging the US. But I think ultimately they will get to where the Fed is, probably in a few months' time. And I think the same will apply in Australia. Australia, like the British, are still a bit sceptical that inflation's going to come down, still a bit concerned that it's still too high. So the bias is still towards hiking. But I think as we go through the next few months, it will become evident that inflation in Australia is continuing to fall, and consequently, the RBA probably won't have to raise interest rates again, and the next move will be down, but probably not until the June quarter, or probably after.
That's good news
September quarter.
Good news, Shane, for households that inflation is finally coming down. What does it mean for investors?
Well, I think it's good news for investors, but you've got to be a little bit wary as to why those interest rates are coming down. Historically, the performance of share markets during the initial phase of interest rate cuts from central banks has been somewhat mixed, because those rate cuts have often coincided with weaker economic conditions. So that's probably the big risk for the first part of the year next year, whether all those rate hikes we've seen so far drive us into some sort of a more severe downturn, possibly recession. But ultimately, the fact that inflation is coming under control and that central banks are moving in the direction of rate cuts has to be seen as very positive. It will ultimately support economic activity, and it will support share market valuations, which were coming under pressure because of higher and higher interest rates. So ultimately, investors should see it as good news, but there could be that little rough patch depending on how economic conditions unfold in the first half of next year.
And what sort of assets or sectors should we be looking at?
Well, from an asset point of view, I think shares are probably going to have another good year. Global shares so far this year have returned something in excess of 20%. So I think we're going to be a little bit more constrained than that. But I think Australian shares will do quite a lot better. We've seen a great perk up by the Australian share market in the last 6 weeks or so, and I think that will probably continue, albeit with a few bumps along the way. And within share markets, investors would be looking to pivot, I guess, to some degree away from the defensive sectors towards cyclical sectors. But just bear in mind on the timing of that, you could go through a rough patch in the first part of the year, but ultimately, as those interest rates kick in, then it would favour cyclical sectors and also share markets over defensive assets.
And the Aussie dollar?
Well, I think the Aussie dollar is heading higher. It's already done pretty well. A few months ago, it was below 63 cents. Now it's around 67 cents. So the basic message here is that the US dollar is coming down. It was very high, very overvalued. It's on the way down because the Fed is going to move to cut interest rates, possibly before other central banks, and certainly before the RBA will. And so the interest rate differential, which has been working against the Australian dollar, will start to work a little bit more in its favour. So we see the Aussie dollar heading towards 70 cents, possibly by the middle of the year. But there's always a risk with these things that it might get there earlier. But yes, Aussie dollar going higher. That means when you've got international investments, you need to potentially look at hedging some of those investments back to the Australian dollar. Otherwise, they could go down in value simply because the Aussie dollar goes up.
And good for international travellers too. Thanks so much for your time today, and if I don't see you before, Merry Christmas. That was Shane Oliver joining us from AMP Capital.